Right. So as usual, the calls, the Zoom sessions, the webinars are recorded so people can have a look at them later. So yeah, anything obviously you say will be part of the recording. So I'm just going to start this now. Right. So tonight, in fact, we've got a couple of different things that we're going to be looking at. So this is the Thursday webinar, where normally we're having a look at some practical things and going into, yeah, some details of real examples of deals with figures and seeing how they work out. So we're going to look first of all at a couple of commercial property deals. So these are bigger ones. These are bigger than your standard mid-terraced house, which we can get at 100 or 120,000. These are deals, I think one of them is around 700,000 and the other one is just short of a million. So I'm going to share my screen. And for those that were with us on Tuesday, we were talking about specifically commercial property investments. I'm not going to redo the same slides, but we're saying that commercial, it's offices, retail, industrial, leisure like hotel and restaurants. And we were talking about different advantages. Commercial property has, yeah, the legislation isn't changing so often when we're doing residential. Residential is good because there's always like a permanent need for people to, houses for people to live in. It's just sometimes a little more difficult or time consuming to keep track of the latest legislation. Like we've got the Renters' Rights Bill currently going through Parliament. That's going to make some changes. But again, if you're coming into, we're going to be talking about later about shared deals like taking shares in property investments. There, the risks are lower because obviously there's experienced people looking after the deals. Yeah, we're saying in commercial, we've got longer leases, professional tenants. We can, on some of the larger projects, we can get higher yields than in residential. But in both commercial and residential, there are ways of increasing the yield, so increasing the return on investment by using leverage, so by using bank lending. And then both in commercial and residential, when we can rent a house out by the room, so that's an HMO, then we're getting higher income. And in commercial property, when we're getting a block of, let's say, for example, small industrial type units, then again, we're not dependent on one single tenant and we've got income from multiple people or multiple companies. Commercial, generally, the tenants are responsible for the maintenance, whereas in residential, then we're looking after the properties. And yeah, within a overall portfolio, it's good to have some diversification. So having some residential and then some in commercial. And in commercial as well, we can use the principle of a commercial valuation, where the value of a property that we can use for refinance is based on the commercial income rather than the bricks and mortar, which is almost always the case in residential. And there are some tax benefits when we're investing in commercial. There are things like capital allowances that we can reclaim, and stamp duty on commercial is less. So that was just the overview of commercial. I'm going to bring up a couple of examples. Just a moment, I need to find this. Yeah, so here we go. This is it's basically, it's a block of offices. It used to be an old mill. This is up in Bradford, so up in the north in Yorkshire. So this here is basically like a commercial HMO. So it's building that's split up into 11 separate offices, and each of those offices is rented out on a separate lease. Like there's varying terms, and when we take on a property like that, we've got immediate income. Generally, what we're doing, we like to get properties with low risk. Low risk means that either we've got a really clear and sure way of renting them out, and we've got a minimum amount of renovation, or the properties are already income producing, but we've got a way of increasing the income. So like in this one, for example, we was able to negotiate a price quite a bit below the asking price, obviously because we've got experience in how commercial properties work, and we were able to go to the sellers and explain why it sort of needs to be at the price that we're proposing and not the asking price. And what happens with these properties? So we're using bank lending. So the purchase price here is 675,000. We can go to the bank and get 70% of that, which means the deposit we have to find is 30%. So we need to find 202,000 for the deposit. Stamp duty on commercial is a lot less than on residential. So here we've got a value of 675 and the stamp duty is 18,000. And then we've got different fees on top of that, the conveyancing, broker fees, and the sourcing fee. So in this project, we need $250,000 basically to get into it. But with that money going in, we've immediately got, this is the current net income after we paid the mortgage interest, is 22,000 per year, which means that's immediately a return of 8.51%. But the really key thing about these types of deal is that when we buy them, we can see that there's potential to increase the income. We can increase the income by each time a lease comes to an end, renegotiating the terms. Sometimes another thing that we can do is if some offices are like underutilized, we can split them into two and create additional space. And when we look at a deal, we look at we're always looking at a 5-year plan. So we're seeing how we can, what potential there is for increasing income and value over 5 years. And when we get to the end of the second year or the third year, we're looking at how much money we can get out of the deal if we were to refinance it. So in this case, based on the estimated new valuation after 3 years, if we were to refinance at 70%, we're going to get 177,000 out. So it's still not all the money we put in. But by the time we get to year 5, we're able to get basically, it's almost all the money out, which means after 5 years, the initial money we've got out, we've got back. We've had all of this income. So we're looking at something like, if we do the calculation, something like close to 200,000 we have had in ongoing income. And now we've got an asset with none of our money left in, and it's income producing. It's the same sort of thing that we can do in residential, but with commercial, we can do like bigger things in one go. And when we're finding commercial properties in, this one it's well outside London. It's in lower cost areas, and we got really good yields on it. To give you an idea of, without going into a lot of detail, what we see on this brochure are some of the outline figures, but we're not just taking those out of the air. If we have a look at this file, again, we're not going to look at everything, we've got all the detailed calculations, interest, all the different fees. And we're also looking to estimate the potential increase in income. Here it's showing all the different, the different units within the building that are rented out, surface areas. And we can see here surface area per square feet. Some of them are quite low, so there's clearly potential to increase that over time. And we've got the projections of rent increases and what we can do with this, which brings us from 72,000 in the first year up to 100,000 in the fifth year. And then, there's different things. This table is enabling us to have estimations of the new values based on commercial valuations, and showing us potential money out at different stages within the cycle. And we've got all the different expenses also over the 5 years. When we're doing property, obviously property from time to time, we need to renovate it and improve it. So when we're taking our figures into account, we've got this line here, which is called CapEx allocation. So 5% of the ongoing income. We do this also in residential, or it's good practice to do this. We put that aside. We put that like in a separate pot. So we're accumulating money to be able to do repairs, sometimes improvements. There might be changes in fire safety regulations or things like that that require some capital expenditure. So we're keeping money aside to be able to do this sort of thing. And we've got the management fees because these properties are going to be professionally managed. So these type of investment, they're hands-off investments and giving a really good return on income. And after 5 years, typically all the money out to be able to reinvest in something else. I'll probably stop at this specific one, but does anyone have any questions about this? I think the people here, Nick and Abed, you're more probably focused or thinking about residential property investments. But if you've got any questions, please go ahead.
Yeah, I just wanted to ask, so being that the major difference is one is will be a property for obviously a business and the other is for a home. In terms of investments, what would you say is the most efficient investment to proceed in? Would it be commercial or residential, or are they just both bringing in the same type of?
Generally, when someone's starting in property, unless they've got like a massive amount of capital, so unless someone's got like, say, for example, 250,000 or 500,000 to invest, and like has really got a good understanding of commercial and says, look, I'm going to go directly into commercial, it's generally a good idea to start in residential, start with potentially some small residential projects, start getting the income from that. And quite a lot of the principles that we use in residential, like I mentioned, HMOs, multiple occupation, I mentioned like adding value to be able to refinance to get money back out. We can apply those in commercial and at a much higher, let's say at a higher level. And the thing with commercial as well, for let's say the same amount of work, it's possible to get higher income if you have a higher amount of capital to put in there at the beginning. And there's also some additional things that, again, we're not using at the very beginning, and we probably don't need it straight away. But things like capital allowances, which are basically all the investment in the internal things of the building, like heating, electricity, different services, all those capital costs can be reclaimed against ongoing corporation tax. And those sort of advantages are not available in residential. So yeah, it's best to start in residential, but as soon as like residential starts becoming successful and people have got a few houses, then to effectively start looking at commercial. And there's also like an in-between step is what we call mixed use properties. So typical example of a mixed use property, it's like on a high street, there are shops on the ground floor, and above the shops, there are flats. And those are good because that's giving us an introduction to commercial. And even if we're buying like a mixed use, which has got a small shop on the ground floor at the front, and then behind the shop and above the shop, it's all residential. So it could be 80% residential and 20% commercial, like the shop. We're paying commercial stamp duty on the complete building, and that can give actually significant savings, especially if we're buying in high value areas. So yeah, I think that answers the question. Yes, both are really good, and generally start in residential, but always keep in mind commercial. And then the other thing that we do in between the two is that sometimes we'll be buying commercial properties like shops, or it could be shops and offices, and we're converting them completely into residential. So we're starting off on commercial. We've got commercial stamp duty on there, and then we're converting them to residential, and then either we're refinancing and keeping them for the ongoing income, or we're selling them off.
Thanks very much for answering my question.
All right, okay. Any other questions from anyone? Okay, what I'm going to do is I'm going to stop this first recording. We'll have a break so I'll turn my video off, but I'll leave the Zoom running, and we'll start again at exactly 7:30, and there we'll be looking at residential, and we're going to be looking at how the pooled BRR projects work.
May I quickly ask, is this presentation available for us to see, or do we only access it via the uh, record on YouTube?
Yeah, so all the presentations that we do and the webinars, they're available. So people that are in my WhatsApp group, there will be the actual links to the Zoom recordings that you can see. And then the full recordings also will always be on the YouTube channel as well. So yeah, those will be available, and you'll have the links for those afterwards. So yeah, I'm going to pause I'm going to back to the Zoom. Yeah, so I'll see you again in just under 10 minutes, okay?
Sure.
Yeah. Right, so we're going to continue today's session. So earlier we were speaking about commercial property and looking at some examples. Now we're going to take a deeper look into some what we call pooled BRR examples.
Sorry, could you explain what BRR is, please?
Right, so we're going to continue today's session. So earlier we were speaking about commercial property. Yeah, just one moment. So I'm just going to find where to start the recording again. Yeah. Yeah, so we're going to talk about a pooled BRR example. And yeah, someone asked what is BRR. So I'm going to start briefly by reminding everyone or outlining what is BRR. So I'm going to bring up a short presentation. So BRR, in fact, I call it BRR, RR with 4 R's, but it's a bit of a mouthful to say all in one go. But it means buy, renovate, rent, refinance, and repeat. What this means is that we start with a pot of money. Let's say if we've got £100,000, that's enough money to find a house that's below market value that needs quite a lot of work on it. So we'll take our £100,000, we'll spend maybe, to keep it simple, £70,000 to buy it and £30,000 to renovate it. So after spending our £100,000, we've got a house that is ready to rent out. That house should have a higher value because we've added value and we got it at a low price. Although we've spent 100,000 on it, let's say we end up with a house that's worth 120,000. So with a higher value that we've created, we can go to the bank and we can borrow money based on that higher value. So typically we're borrowing 75% of the end value. So we've got an end value of 120,000, 75% of that is 90,000. So we get back from our initial money in £90,000. So that means in reality, we've got most of our money out. We've got a property that is what we say is cash flowing. So that's giving us positive cash flow. That's giving us additional money every month once we pay the mortgage interest and the different expenses. And so we're able then, as soon as we've done the first one, we might need to just top up with a bit of extra money, but then we can buy the next one. So each 6 months or 9 months, depending on how fast we're doing it, we're adding an additional house to our portfolio of houses with almost no additional money in. So after, for example, if we're doing really aggressively and we're doing 2 houses a year, within 5 years, we can end up with a portfolio of 10 houses, almost from only the initial money that we put in, especially when we've got quite a few going. We've got the ongoing income, so that's building up some additional cash so that as soon as we finish one, we're able to go into the next one. So that's the principle of BRR. But the thing is, in order to do BRR to buy a complete house, then you need, something like £100,000. It's possible to do it with less if you're using lending at the beginning. So let's say you've got £40,000. It's possible to go to the bank and use what's called bridging finance to be able to borrow enough money to buy the house and renovate it, and then refinance afterwards. But if you haven't got 40,000, and also if you've got 40,000, you still need to have sufficient income and credit scores to be able to borrow the initial money. It's easier once the house is finished to refinance because there's less risk. The bank is lending against a property that's already finished and is income producing. So when people haven't got enough money to buy their own BRR, it's still possible to get all the advantages of a BRR by coming in with other people and basically taking a share in the purchase of a property. And that's what we're going to be looking at in a specific example today. So really fast, how does it work? So what we've got here is what I just said. We need 100,000 to be able to buy a house. This is in areas where we can get houses at really low prices. Could be like, for example, in the north of England, northwest, some areas in the Midlands, but quite a bit out away from Birmingham, or it could be in South Wales. We're doing quite a lot of stuff in South Wales. Just happens that I had my initial portfolio there, and we've got a build team and people that are sort of on the ground looking for deals and finding deals all the time. So we need 100,000 to get into a deal. So how does it work when it's a pooled investment? So basically from 5,000 upwards, it's possible to take a share in a property that we're going to do the BRR on. And so if it's, say, for example, £100,000 that's needed, £5,000 is 1/20th of the property. And that gives a share of the ownership, share of the ongoing cash flow. And when we go to the bank, when we finished it, it's also money back on refinancing, and then obviously the ongoing income. How does pooled BRR work? So what happens is we set up, so people first of all put the money into the deal. So we like at the moment, for example, we're starting a new, the next pooled BRR. We've got 4 people that have already subscribed to it. So I think we're at something like 35,000 so far on this one. Other people are coming in. So people are putting the money in. And as soon as we've got the that 100, well, not, we're already looking for the property and we've got 2 or 3 potential ones. And then as soon as you've got both the property and all the money is in the company to get going, then we're going to buy and get onto the project. When we set up the project, we define what we're going to be looking for. So the people that come on board, it's not like random, I'm putting money in what sort of property we're going to buy. We're saying that up front. So here we've got the description of what we're currently looking for the next pooled BRR project that we're doing. So it's going to be in the South Wales valleys. These are the areas that are up from Cardiff, where property prices are obviously, Cardiff is the capital of Wales, so it's more expensive. But these places are something like 30 or 40 minutes drive or train journey away. And house prices are probably half the cost of what they are in Cardiff. So our criteria is somewhere in the South Wales valleys, maximum 15 minutes walk to a train station with regular services to Cardiff. We're looking at buying a house that's freehold, a terraced house, between 60 and 80,000. And with the renovation cost of between 20 and 35,000. These figures are variable because sometimes we might get a house that's around 80,000, but only needs 20,000 of works. Otherwise, we might get a lower price and more works. So we're looking at a total investment of 110,000. That also includes things like sourcing fee, management fees, everything needed to get the product, the property, the project off the ground. And it also includes contingency. We're going to be operating this house either as a standard buy-to-let, or if we're able to, as a mini HMO, like renting out rooms to get a bit higher ongoing income. And we're expecting when we finish the project to be able to refinance, so within 6 to 9 months, from the start, and give everyone back 80% of their money, which they can reinvest in another project, or if they've got something else they want to do with it, they can do with that. And on the money that's left in the deal, so let's say someone puts in 10,000, after 6 to 9 months, that person will get 8,000 back. 2,000 remains in the property, in the project, as like co-ownership. And on that 2,000 that's left in, there's going to be something like 12% annual return, and that's paid out each month. What is paid out is a share of the net income from that property is generating. So how does it work? So the total investment is obviously the purchase price, the stamp duty, sourcing fee, legal costs, renovation costs, contingency. What I'm doing here, I'm not taking shares in the company, but I'm putting in place all the legal structure, because obviously it's not the first time that we've done this. We know how this works. We've got our templates, we've got the legal agreements in place. We know how to set up the companies, register everything with Companies House. Obviously, people's individual shares are registered with Companies House. And to cover all those setup costs, there's this 5% acquisition fee that people pay when they buy the share in the property. There's a shareholders agreement, which is a legal document which explains the rights of each shareholder, so everything's clearly defined. Then we buy the property. We do the renovation work. We include a contingency if we find, when we start breaking things and starting to work, if we find, for example, that we have to like rewire the house, then we've got enough contingency to be able to do that. And also ongoing, we keep enough money to cover 6 months loan interest, just in case there's a problem with the ongoing payments. But we do in fact take insurance to cover that. Then once we start renting out the property, all the people that have a share in the property have their share of the ongoing net income. And then we refinance to be able to get money back to each shareholder. And there's also the possibility, shares can be sold at any point in time, but there needs to be someone to buy them. However, within the structure of the company and the setup and the shareholders agreement, there's the guaranteed possibility of selling the shares after 5 years, and that's based on a new official valuation of what the property is worth at that time. Are there any questions on the overall principle before we look at a specific example?
I'd like to look at the example first before I ask anything.
Okay, that's fine. We're going to go on to an example then. So let's have a look. So let's a moment. This is what a mid-terraced house looks like in the South Wales valleys. This is a potential candidate for this project, or it'll be a similar one. So if we have a look, yes, they're like brick or stone built houses. That's the back garden. Obviously, there's loads of hills around here. That's also looking from the back. So there's a house, and typically there's an extension that here we've got probably the kitchen and then the bathroom. All the houses that we're potentially buying, we're finding houses sort of all the time, both for individual investors who say, can you find me another house? We want another BRR project, or can you get us 2 houses? So we've got people on the ground going around inspecting properties, negotiating with the agents, and some we're buying things also in auction as well. And then we've got, when we see something like that, this obviously is a dated kitchen. So to increase the value, we'd be putting in a new kitchen. Same thing, we'd be getting rid of this and putting in a new bathroom. And yeah, generally refreshing the complete house, sometimes doing replastering, work on the electrics, things related to fire safety. There, for example, we're going to be boxing in the boiler. There's clearly a bit of damp there, so we're going to be checking that and dealing with everything and getting the house up to a good rental standard. Yeah, so when we're looking at potential deals and talking about them with investors, we've got all the photos, and let's see if we can do this somewhere. We can do it faster. I can't quite see where. But yeah, but that's we do videos so we can ourselves remember what it looks like. And on these videos, you've actually got the person that's doing this is one of our colleagues. He's actually making comments as he goes through the house, looking at different things. Because on the back of that, we're estimating what's the cost to renovate that. That's obviously the agent that's trying to hide from the videos. So yeah, but if we go on a bit faster. Yeah, upstairs, looking at the bedrooms. Often we're looking at, if you've got a really big bedroom, like a 2-bedroom house, we'll be looking to see if we can make that. This house has already got 3 bedrooms, so we don't need to do anything. But if you've got a large bedroom, then we'll look at dividing it into 2 to make an additional bedroom, because we're always looking at ways to add value so that when we get to the end and we're going to look for the refinance, we can get most of our money out. So that's what the house typically looks like. And now we're going to look at the figures. So we've got our detailed Excel file that includes all the expenses. What we've got here is what is in yellow is the part that's related to the pooled part of it, because so in this deal, for example, remember I said that we need this project is going to be around 110,000. This specific one would be 113. So that means we just need to have one extra share in it to be able to yeah, get over the line. Or it could be that someone that's already like taken a share of the project will say, okay, I'm going to take another share, so that yeah, and obviously they get a little bit more of the income. So on the figures, we've got the purchase price, our stamp duty, the sourcing fee, the company setup and directors fee for the first year. So I'm providing with my company, generally it's myself, the director's service and looking after all the company stuff, ensuring it's set up properly, but I'm not a shareholder. Obviously, the shareholders will agree that I'm the director, and down the line, if they want to change that, obviously it's a majority vote. It's possible to do that. Then we've got the conveyancing. So we've got the amount of money that we need for the purchase. We've got the estimated renovation conversion costs. We always add a contingency on top of the renovation and conversion costs. We add a fixed contingency of £2,000 and 15% of the renovation costs. So we've actually added into here £5,000. In practice, sometimes we need a bit of it if we find that there's some extra work or something happens, or we end up taking a month longer. But generally, whatever that contingency is left, it's not money that sort of disappears. That's rolled over, and then when we're ongoing, that goes into the maintenance fund. And if we end up with more money than we actually need because we spent a little bit less, then that money goes back proportionally to the shareholders. So basically the total money needed to get, and we've got holding costs, which is like council tax, utility bills and insurance, between the time when we buy the property and we finish the renovation, we're ready to rent it out. So we've got total money in here of 113,000. We set a minimum of 5,000 to come in, because the principle here is that there might be 10, maximum of 10, maybe 15 shareholders, so people will sort of know who the other shareholders are. But the value of each share is 500. So if someone wants to put in, for example, 7,500, it's possible to do that because we got the individual shares. We're looking at an end value of 125,000. That's based on our experience and by looking at data of similar houses that have actually sold in the area. We never take into account for sale prices because agents can put whatever price they want. We use those figures based on actual sold prices in the area. So this means that someone who's taken a share that was worth 500 at the beginning, based on the end value, that share is now worth, let's say, 550,000, and that obviously is equity in the property. If we get the refinance at 75% of that value, there's different fees on the refinance. So that's the actual money, 91,000 that we get out. And when that's divided up per share, someone that put 500 in for a share will get back 402 pounds after probably something like 9 months. However, equity that is in other words, the money that is in the property, like the 25%, because 75% is now sort of in inverted commas owned by the bank, it's the bank lending, but that remaining 25%, we call that equity. So if we were to sell the property and obviously pay back the mortgage, then each shareholder would get £129 for each share. So there's obviously added equity, and over time, the value of that is increasing as property prices are increasing. And then on the right-hand side of this file, we're looking at what's our expected income and expenditure to understand the ongoing income and how much each shareholder is going to get per month from that income. So we've got our rental income, we've got agency fees, insurance, different stuff. So at the end, this is our total expenditure. We've got our net income before the interest payments, because now we've refinanced, so we've got mortgage payments. Those are interest payments. So the cash flow is £270 per month. And for each £500 share, it's £1 per, well, just over £1 per month, which means, and this actually is 14.6% annual return on the money that's left in the projects. Obviously, it's a lot better than leaving that money in the bank. And it is we're starting to create ongoing income. And obviously, as we just said before, the value of the share, the value of our share of the property is increasing over time. So so someone who's bought, for example, £5,000 worth of shares at the beginning, get £4,000 back, and every month they're going to be getting £10, in fact, £12 income paid into their bank account. And then if we were able to operate this property as an HMO, it's not always the case. We need to see if the rooms are big enough. There's quite a lot of criteria. And if we were doing an HMO, in reality, the renovation cost is going to be a bit higher, because if we're doing an HMO, we have to have fire doors on all rooms, emergency lighting, a higher level of fire safety with more interlinked smoke alarms, heat alarms, and things like that. But if we can do it, that's generally justified. And here, if we were to operate as an HMO, that would be the monthly income. However, there's a lot more expenses, because when we're operating as an HMO, we're paying the bills. So those obviously have to be taken off. But we still got here, instead of the cash flow of 270 per month, we'd get a cash flow of 408 per month. And so for each £500 share, that's the amount of money that's going to be coming out of it. So that is the principle. And yeah, as I said, we've got one currently open for people to come into anything from 5,000 upwards. And most likely within 2 to 3 weeks, we'll be ready to actually go out and buy the property. And we'll either buy it, it could be the property that we saw just now or a similar one. And it could be one that's on the open market where we can negotiate a good price, or it could potentially be something that we get in auction. So yeah, ready for any questions about how this works. And yeah, ready to answer all questions. Well, did I explain everything so well that there's no questions?
I have a question. I think I'll start.
Yeah,
So, Trevor, do you think it's better if someone spread out, let's say they have, I don't know, 10, 20,000 to spread it out on 5,000 on each property, four properties, or maybe to put 20K and have a bigger share in one property? Uh, which one do you think is better?
to be honest, I would probably go for a bigger share in one property because the risk is relatively the same because we're always taking out this rent guarantee insurance. So if a tenant stops paying, we've still got the income coming in. And if someone's got a bigger share, they've got like, I'm going to say, a better feeling of investing in property rather than like if you're investing, I don't know, let's say in stocks and shares, and you've got £5 here, £5 there, and £5 somewhere else. You don't necessarily feel any like sort of feeling or association with one company. And it's the same here. If, for example, someone puts that 20,000 in, let's say the specific property, this deal that we're going to be buying now, they'll, because also, by the way, I didn't mention this, people that invest in property, obviously they get up-to-date information on what's happening with the renovation, photos, sometimes like a video call when there's one of our project managers looking at the property. People also have access to the accounts, so the detailed accounts where what money's being spent, what the income is, how it's working. So if they're taking it on one specific property, it gives a better idea. And if the aim, because quite a lot of times the aim of getting into the pool BRR is to get a feeling for how it works, with the possibility that down the line maybe they'll have some income, some inheritance, or accumulate enough savings to be able to get into their own property that's 100% theirs. And yeah, I mean, that's a recommendation, but both are possible. Someone might say, look, I prefer I'm putting 5,000 here, 5,000 there. Generally, we're doing one at a time. We're not like, so we're doing one when it's like finished. So at the moment it's probably something like one every 1 to 2 months. So if someone's got 20,000 to invest straight away, if they're doing it in our properties, they're going to end up, if they want to do 5,000 each time, they're going to end up waiting probably 6 to 8 months before they've deployed that capital. And so there also, it makes sense to deploy it all at the beginning because they're immediately getting it. And of course, after 6 to 9 months, if they put 20,000 in, they're going to be getting back something like 16,000, which they can, in any case, reinvest in a different property.
Thank you. That answers my question.
Yeah. Are there any other questions?
I have another question.
Yep.
And this is from tax perspective. So the income I'm earning from this, do I need to or have a limited company or how do I pay? Or has the tax been paid on my behalf, or do I need to pay tax on this income?
No. So what happens is this is a company, so people are buying shares in a company that owns one specific property. The company will be paying corporation tax on profits, and that is deducted before we pay out the income to shareholders. However, that income is paid out as dividends. So if people buy these shares in their personal name, then the money they're going to be receiving each month will be dividends that need to be declared on like personal income tax. And depending on, there is like an allowance, I don't remember what it is, it changes almost every year as well, and it changes with different governments. If that's going to be below the personal allowance for dividends, then that's fine. Otherwise, people obviously need to declare that and pay the income tax on that, depending on whether they're taxable and what bracket they're in. If, however, someone sets up their own limited company, like basically that will be a property holding company, and buy the shares in this pool by BRR from their holding company, then the dividends that get paid to their holding company will not have to pay any tax on it, because corporation tax has already been paid in the property owning company. And as long as they hold that money in their limited company, and if they potentially reinvest it, there's no tax to pay. It's only if they want to take personal income from their holding company, then it's going to be exactly the same situation. That's going to be dividends, and they'll need to pay tax on it. There is just one like little thing to add, that when people put initial money in, so when you put money, if for example, when you put money into this, for example, into your holding company, that is money that you've already paid tax on. So you can take money out of your holding company up to the amount that you put in without paying tax. That's generally called director's loan account. But these are details. So there are ways to optimize this.
Sorry, if I get what you're saying correctly. So let's just say someone invests 20K in and they're taking 16K, which is 80% in 9 to 12 months' time. They don't need to pay tax on
There's
that
no
money.
tax at all on the money that they get back, no.
Okay.
Because when someone buys a share, in reality, so someone's buying a £500 share, £1 of that is sitting on the company accounts as share capital, and then the remaining £499 is sitting on the company accounts on the account book as shareholders' loan account. So when 80% of that, obviously it might be a bit more, it might be a bit less, depending on the official end value of the property, that money goes back to the shareholder as return of their shareholders' loan account. So that's completely tax-free. It's only the ongoing income. So on this sheet, the monthly income, that if they're taking that, if they put the money in personally from their personal account, then there is potentially income tax on that as dividends.
Thank you.
It used to be, I can't remember, I think it was 8% tax on dividends up until the higher tax bracket.
Sorry, I've got a question too. I was
Yep.
gonna ask, for someone that's doing this for the first time, would you suggest they first invest as high as possible or as low as possible? Like how would you advise us towards that?
Well, in practice, what the advice would be is these are like really low risk investments, because we're not buying something where we don't know what property we're getting. We don't know how long it's going to take to build it. These are what you saw like in the example, they're properties that exist. We know there's a very high rental demand in the area. When we put a property up for rent, The next day we're going to have 50 people applying to rent it, and it'll be off the rental market within 3 days. So we've got no risk there. The company's properly managed and set up. So the question is more, if someone's got, for example, a certain amount of money sitting on their saving account, then we all recommend that obviously people don't spend all of that money so they haven't got like it. Because when you put money into a project like this, you can't decide the next day to sell those shares. You can say that you want to sell them those shares, but if no one wants to buy them, you've got no way of getting that money back until obviously the time when you get the 80% back, and then after 5 years there's a guaranteed buyback. So this is like a long-term investment. So, however, there's no real point in, let's say someone's got £10,000 in their savings, and they decide that they want to keep, let's say, 3,000 as like cushion in case something happens. Then it's fine, I would say, to go and directly invest that 7,000 because it's going to be immediately producing income. But on the condition that people understand that it's a long-term investment. It's what I would say is a safe investment. People say nothing is safer than houses, and this is a house. But yeah, to understand that it's a long-term investment.
Trevor, how did the investors benefit from the capital growth of the property, the equity of the property long term?
So yeah, long term, what happens is, so generally we're holding these properties sort of in inverted commas forever. We're not planning to sell them, but we put into the shareholders agreement every 5 years there's a guaranteed buyback. So let's say you've got £10,000 worth of shares in this particular property, and let's say after 5 years it's not worth 125,000, but it's worth, let's say, 180,000, which is quite possible based on increase in property prices. That means that each share would be worth, how many shares? Would then be worth, just a moment. If the property is worth 180,000, we've still got lending. So we've got bank lending at 93,750, which means that the overall equity so in other words, if we were to sell the property and repay the bank, we'd have 86,000 to distribute to shareholders. In reality, we'd be paying corporation tax on there, like the equivalent of capital gains tax. So let's say we had, after paying the tax on it, we'd have 60,000 to distribute to shareholders. Then each shareholder would be entitled to receive £264. So if you said, I want to sell my shares, we're guaranteeing, obviously there's some specific criteria on this, that you'll be able to get 264 back. So the 120 that was left in there at the end is basically doubled. And the way that works is, let's say you're the only shareholder that wants to sell. First of all, we offer that to the other shareholders. So if someone says, I'm interested in buying your 20 shares at this price, then that's fine. We sell them, you got your money back. If no one wants to buy them, we ask on the open advertising, like different groups. I put on my WhatsApp group, other groups saying, look, we've got these shares available. Is anyone interested? If no one wants them, what we can do is, because we've got 180,000 value, we can go back to the bank and we can potentially borrow more money. So we can borrow an additional, we can borrow up to 135,000. So that means we can refinance, we can pay back the shareholders that want to get out of the deal. And then obviously then the existing shareholders, the value of their shares increases because obviously we've taken some new lending. And if, the fourth case, and all this is in the shareholders agreement, in the fourth case, let's say 60% of the people wanted to sell their shares and get their money back. In that case, let's say the remaining 40% are not going to have the choice. The only way of being able to realize that buyback is we need to sell the property, and in which case we sell the property and everyone gets their share of the gain. So it's not exactly complicated, but we've got these few steps that enable us to guarantee the buyback, and the new value is based on an official RICS. So that's Royal Institute of Chartered Surveyors, an official valuation. It's not someone putting their finger in the air and saying it's worth this much. It's a proper valuation. Does that answer your question?
Yes, it does. Thank you. So will all this be put in terms and conditions so that whoever is investing would know all of this?
Yeah, because in reality, there's two things. There's this PowerPoint explains how it works, by the way. So exit strategy and share buyback. This is explained in like sort of basic terms, in like simple English. So he says the buyback option, how the value of the share is done, and then the four things that I just explained: other shareholders buy, outside people buy, refinance to release funds, or we sell the whole property. And that is all this, everything that's in this document is in the shareholders agreement, which is basically a 10-page document. And when people buy shares, they're signing to say, we agree with what's in the shareholders document, the shareholders agreement.
Hi, Trevor.
Thank you.
Yeah, hi.
Sorry, I joined not too long ago, so I'm not sure if you've already talked about this. So is there like a minimum amount that someone can actually buy in? Is there like a minimum amount of money?
Yeah, generally we're setting a minimum amount of £5,000. The shares, the value of a share is £500. But the idea of limiting it to 5,000 is so we don't end up with like 100 different people in a deal. Because the idea is that people have like some, so that means that if someone wants to buy £6,500 worth of shares, it's possible. They haven't got to buy multiples of 5,000, but we set it generally as a minimum of 5,000.
Okay, thank you. And on average, what kind of return could someone expect from that amount?
Well, in reality, we're talking about, it's a bit difficult to, not difficult to explain. If you, let's say 10,000, because then that's easier to make the calculations. Basically, someone's putting 10,000 in to get the project off the ground. From that 10,000, after around 6 to 9 months, when we finish and we refinance, they're going to get £8,000 back. So they're getting the money back. And on that 2,000 that's left in, and that obviously is like left in the deal forever until like they buy back those shares or we sell the house. We're talking about something like 12 to 15% annual income on that money that's left in the deal.
Okay.
Yeah. Plus the fact that that is actually the real income. But if we also add on the, let's say, the increase in value, because the property is increasing in value. So although we've got the income, we've got the, let's say, the residual value, what we call the equity that's in there. So probably over, for example, over 5 years, we're probably talking about like 20 to 25%, accumulated return per year. And also in these deals, of course, we've got the initial rent, but every year the rent is increasing. So the rent is increasing. So it's also like we say hedging against inflation. And generally rents are increasing higher than inflation because there's more demand than there are houses available. So
right.
yeah,
That answers my question. Yeah, thank you.
okay, great. Are there any other questions?
One more question from me,
Yep.
Mr. Trevor. So, we're in the month of March, for example. Let's just say someone invests today on this property. From which month would they start getting the returns back? As in, when would they start renting, and when would they start
Okay, all right, yeah.
getting the monthly
So
income?
let's say someone puts some money in today or tomorrow. So that money is like sitting, not obviously temporarily until we've actually got the property. So let's say we end up buying the property realistically within probably 4 to 5 weeks, maybe 6 weeks time, because even if we got the offer accepted, we need to go through conveyancing. So let's say end of April, we've got the property. Because we've got our own build team in the area and we know we're going to get the property, we're almost ready to go in and start doing the work the same day that we get the keys. It might be like within 1 or 2 weeks. So probably we're typically talking about 3 months maximum for doing the renovation and getting it ready to rent. Renting it out is generally really fast. It's like 1 or 2 days. So we're talking about end April, May, June, July. So probably, so August likely we've got a tenants in there. So on the 10th of September, they're going to be receiving the monthly income. And then probably something like towards the end of the year, maybe January, they're going to be getting their 80% capital back, which they can then invest in another property if they want or use something else. In reality, it's the same sort of time frames as if someone's doing it themselves on like a complete house, except in practice it's a bit faster because obviously it's not the first time we've done this, and we're doing it like in an accelerated way with the aim of getting it done and getting the money out and getting on to the next one, sort of thing. So it's probably in reality 2 or 3 months faster easily than when someone's doing it themselves. And as well, when a lot of people, when they're doing it themselves, strangely, well, not strange, that's just how it is, they're waiting until the house is actually rented out before contacting the broker to arrange the refinance. We're looking at the options for refinance as soon as you've actually got the property, so that when it's ready, we're sort of ready to put the application in. Does that answer the question?
Yes, it does. Thank you.
Any other questions?
Yes, just wanting to find out, is there like a website or somewhere that have like information that can be read, digested, and maybe your website, something like that?
There's basic information on the website ProperInvestment, proper-investment.uk. But what are you in the WhatsApp group, Tubo?
You mean WhatsApp group?
Are you in my WhatsApp group?
No, not yet.
Okay. How did you get the link for this Zoom?
My brother sent it to me. So it's Omotayo there, so that's my brother.
Okay, right, yeah. If you ask Matayo to send me your contact information, I'll add you to the group, and I can send you like copies of these different documents.
Okay, brilliant. Yeah,
Yeah.
thank you.
Obviously, we can give you the link to the website, but the website is more like sort of promotional sort of thing. I mean, everything on the website is true and correct, but it doesn't give all the details, because giving all these details is like too much to put on a website. And there's going to be the recording of this question and answers as well, so you'll be able to look at that and yeah, revisit some of the answers.
Okay, yeah, no, thanks for that.
Okay, no problem.
Trevor, I was gonna ask if it's okay, we could have a private like 5-minute call. I'd ask us a personal question.
Yeah, that's fine. Yeah, we can do that afterwards. Yeah, or afterwards or tomorrow, no problem.
Great.
Right. So yeah, we've actually overrun a bit, but it's good. Good that people are asking questions, because that's what it's all about. Yeah, because the key thing is obviously there's different probably investment schemes around. I'm going to say big difference here is it's like full transparency, and people that come into these know exactly exactly where the money's going and what the property is and how it works. And yeah, for people that want to understand, some people that come into these just come in because they want the return on the money, and obviously it's a good return compared to other investments. And some people do it obviously to get the return on the money, but also to get some of the education and to follow what's happening, with a view to potentially down the line doing it themselves. Okay, well, thank you for your time, and hopefully that was useful. And yeah, send me messages if you've got any questions after this.
Thank you very much, Trevor.
Okay, yeah, thank you. Yeah.
Thanks a lot, Trevor. Thank you.
All right. Yeah, cheers. Bye, everyone.
Thank you, Trevor.